Hello, this is Maiken from the Sanostro team. We wanted to share this short analysis with you before Christmas and hope you'll like it.
Some investors think the bull market still has room to run. Others see the market getting longer and longer and are beginning to feel the fear creeping back. The table here compares the investment gains over the 13 longest bull periods with that which was lost in the following bear market, assuming one stayed fully invested throughout. The average bear market wiped out more than 70% of the investment gains from the previous bull market. Avoiding these kinds of large drawdowns results in a better long-term performance, even if you end up giving up some return during the strong markets. Based on these considerations, it is probably important to prepare for the bear while you are running with a bull.
After the bursting of the tech bubble, years of fragility followed. Along the way to the market bottom in March 2003 were high unemployment rates, the eruption of corporate scandals from WorldCom to Enron, a breakdown in trust and confidence, and the terrorist attacks of 9/11. Low interest rates, low lending standards, and an accommodating Federal Reserve turned things around. Housing prices soared while household debt expanded with mortgage-backed securities and collateralized debt obligations. In October, 4 years later, the bull market ended in a terrible bear market. The housing bubble had burst after prices peaked in early 2006, and the subprime mortgage industry collapsed in March 2007, with many of the lenders filing for bankruptcy protection. The crescendo that followed left so many so scarred they avoided stocks for years into the current bull market. Alan Greenspan famously called it a once-in-a-century event whose consequences proved far more devastating than had been widely expected.
When people speak of the great stock marathon that began on Black Monday 1987 and ended with the bursting of the tech bubble in 2000, they consider a bull market that lasted for 4,494 days, from October 1987 to March 2000. It was actually interrupted twice with a 20% correction. The longest bull market lasted from 1990 to 1998. In the aftermath of the savings and loan crisis, the market settled into a steady climb that would last more than 8 years and end with the LTCM crisis in 1998. The bull market from 1982 to 1987 followed the extraordinary, painful, but in hindsight brief recession. This bull market was recently surpassed by the one we're currently enjoying. Things took a turn for the worse after Fed Chairman Paul Volcker declared war on inflation and hiked interest rates dramatically, tipping the US economy into recession. The bull market that began in 1949 drove the S&P up 267%, despite the Cold War, the founding of the People's Republic of China, the Allies' struggle with the Soviet blockade of Berlin, and the Korean War. 1942. Victory looked far from certain in Europe. The Allies had lost most of the Philippines, Singapore, Malaysia, and the Japanese were driving into Burma. And then the tide of the war changed, and the stock market continued to climb through the rest of the war, peaking in 1946. This bull market followed in the wake of 1929 and the gloomy period after, where stocks lost around 86% of their value. It would take until September 1954, nearly 25 years, before the S&P regained its 1929 peak. Of course, the S&P did not exist till the 1950s, so the numbers are based on how analysts believe the S&P would have traded.
Thank you so much for watching. We in Sanostro wish you all a Merry Christmas and a Happy New Year.